I am always behind. Oh, look, we're live. Everyone, give me a second. As always, let me make sure that we are streaming properly on all the various social media platforms, including Mr. David Lynn's handles. For those of you who are watching this live, I'm sorry. No, I appreciate those that continue to watch these live streams as I do them almost every day with various guests. If any of you want to interact and engage while we're live here, doesn't matter if you're on LinkedIn, X, YouTube, we can see your comments, which means ask a question. I'll bring it up as we're chatting here. I'm excited for this conversation with David Lynn, who puts out more YouTube videos than Trump gets fact-checked during debates. The guy's been a monster on YouTube. I was saving that opening, David, for a little bit of time there. But he's got a lot of interesting insights. Done very well in terms of the kind of reach he himself has put out there and built, and has some phenomenal guests himself, including me, by the way. Every now and
then. Yeah, you're the most important one.
Yeah, obviously. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Join me for the Rough Hours, Mr. David Lynn of the David Lynn Report. David, I know a lot of people are fans of yours on YouTube, but who are you? How'd you even get into this?
Hi, thanks for having me on your show.
Yeah, bring it.
I'm streaming this on my platform as well. This is my first time streaming from Restream. This is fun. You still there, Michael?
I am. I'm just. I'm gonna pop in and out to make it more movement. You know this stuff with the videos. You got a movement in the videos.
Okay. Yeah. You got it. Yeah. You gotta do the split screen and the solo.
Yeah, all that stuff there.
My name is David. So thank you all for tuning in and listening to our stream. I started this channel last year. I currently have over 200,000 subscribers. Thank you all for joining the community. I was a news anchor for 3 years before that at another channel, and then I was a macro researcher at a firm called BCA Research for 5 years before my career in financial journalism, and then I did my finance degree at McGill. That's my bio in a nutshell. And I love interacting with the world. This is how I see my job, just talking to a lot of different cool people about what's going on and learning along the process. And I hope people learn by watching my show as well. I do make a lot of videos on YouTube. I mean, I think I try to do more than last year. They say quality beats quantity. I say, why not both?
I think quantity I always say in the war of quantity over quality, quantity tends to win because people's attention spans are really short. So you just got to keep on putting stuff out there. But you do have both a nice balance of the two. Is what you do now easier than being a researcher, easier than being a trader?
Well, I was never a trader, at least not professionally. In fact, I've been public with this several times. I was not a good trader in my early 20s. I opened a options account and just blew through it in about 3 weeks. And I realized, you know what, this is not for me. But I taught myself how to trade, and I wasn't good at it, and I knew that was my career. This is definitely easier, I find, than investing. I often say to people, I don't know the answers to most of the questions I ask on my show, which is why I'm asking them, by the way, because I want answers to those questions. But if I knew the answers to those questions, I'd probably be a very good investor. So I definitely think that my job is a lot easier than yours, Michael.
My job sucks, man, because I'm not just dealing with markets. I'm also dealing with competition in the fund world. And the only way you can have competition is by doing something different, which of course means when it works, it really works. When it doesn't work, it doesn't work. And
this is an important question that came in. Are you working so hard that you don't have time to shave all the time? That's exactly it. Sometimes when I'm not going for the country music look, it's just because I haven't had time to shave.
I would not have pinned you as the country music look guy. I mean, I just
I'm missing the cowboy hat.
I mean, it's a different part of the U.S. country, at least. Okay, so hold on. Let's talk about recent market movement, because there's been a lot of it. We went from the Fed lowering rates, which meant rates rose. We went from China is dead in the water to everybody must buy China to everyone again is saying China is dead in the water. What the hell is going on, man? No one better than you in terms of explaining what's happening.
Okay, so let's just talk about what happened today. You want to start with China?
Yeah, let's start with China.
Stimulus has been hailed as the biggest stimulus package since 2008. Not only did they drop the benchmark policy rate, they also dropped mortgage rates. I just came basically out of bed this morning and read this story. China's stock market fever breaks as authorities disappoint. So the epic Chinese stock market rally, I can't remember what it was. I think it was like 30%. The Chinese indices, that came to a grinding halt today, especially the Hang Seng, which was down the most in a single day, I think, since 2008. Apparently, a news conference led by the government yesterday disappointed investors who were expecting more stimulus. So I guess once you're expecting something and your parents don't live up to that hype, you get disappointed and you throw a fit. Markets are basically behaving like little children. That's what they're doing today, especially in Hong Kong. So what happened today? Sinking feeling. Yeah, that's the chart of the CSI. Well, not CSI. Hang Seng. CSI something else.
Why is that not a buy the dip? Like, why does buy the dip only matter and only said when it comes to the U.S.? I mean, a move like that, it's like, I don't know, maybe you could rally again.
Remember in 2014 when people said the same thing about A shares? Yeah, I don't know. I don't know.
Yeah.
But this is also why. Okay, so you tell me. I mean, if you look at the technical indicators, maybe it's broken below resistance or support rather, probably. But there's probably a good reason for that. One could argue this whole run up, expecting if you're pricing in a certain amount of stimulus, this whole run up is just a lie, because now the stimulus has to be repriced, and arguably that is the new reprice. But we'll see. In recent years, China's stock market has enjoyed similar stimulus. I am curious to see what base metals have done, because base metals climbed tremendously the first time there were stimulus. You can see my screen. Yeah. All right. So here's the SPX. Copper. Let's do 5-day chart. Yeah. Copper took a big slide. Okay. So that makes sense. Let's do nickel.
But it's not like these commodities have given back all of their gains. I mean, yeah, and neither China's markets. I think there's a lot of. Well, I'm skeptical that it's over personally.
I mean, look, what the bull run in the commodities.
The bull run commodities and just in general, the China reallocation. Like, China is so underinvested from so many perspectives that for anybody to say, well, it's got to come back in, it's like, I don't know, and it's like, it's still the ultimate contrarian country equity play.
Yeah, and I think to a certain extent, Chinese equities have just been neglected all year. If you take a look at Hang Seng futures, let's do year to date. Notwithstanding this huge run up from the stimulus announced in September, what has it done versus American markets? Not great. If you just forget this part, right? The SPX is up 25% from the beginning of the year up until the middle of September, and the Hang Seng's up only 18. So it's just been like a neglected market ever since. And I know you're going to say, well, the S&P is just the NVIDIA driving it. So let's take that out. Let's just take a look at the Russell. I suspect the Russell has started to outperform recently. Let's do RUT, actually. Let's do that. Yeah, even the Russell has kind of, well, not really, 18%. So, I mean, small caps in the U.S., as you know, have been underperforming the large caps, and even that was on par with the Hang Seng up until 2 weeks ago. So I just think that the Chinese markets have been just neglected by investors all year round, and it was at some point due for a breakout, and we got that breakout, and now it's been overrun, and people are taking profits on the back of today's news. So we talked about this briefly offline. I kind of agree with you. This is the pullback today is not a significant issue in the grand scheme of things, given how much it's already run up. It's like it's already up 30%. Are we really going to care that it's down 5%?
Right.
Well, let's take a look at some other news. Israel sends thousands of troops more into Lebanon. I think the escalating war in the Middle East is more significant than what's going on in China.
Oh, we should be clear. Is this World War III, 4, or 5? I don't know what number we're at.
I think it's like 2.5.
Is it? Okay, I can't quite tell. I can't keep up. Yeah.
Yeah. Okay. Neither can I. That's why I have to pull up today's news, because this thing changes by the hour. So when was this reported? 3 hours ago. Okay, relatively recently. All right. So the Israeli military is deploying more troops in Lebanon. I talked to my Lebanese friends about this, and I asked them, what are the Lebanese forces doing? Because we have to differentiate between Hezbollah and the Lebanese military, which apparently has, for the most part, been sitting on the sidelines up until now. I'm not a military expert. I plan to ask Lebanese military experts about this on my show in the coming weeks. But apparently it's because, from what I've heard, they don't have the ability to do so. And they've just been shuffling forces around. And it's interesting to see what the official military of Lebanon is doing. Anyway, the Israeli military refuses to provide official figures on its force numbers, but the divisions are not expected to be at the maximum estimated size of 10,000 apiece. Okay, so things are escalating in Israel. What is really shaking markets is the Iran and Israel news. So Iran strikes Lebanon, and what is Iran going to do next? They haven't retaliated yet. Okay, so we're waiting for an Israeli retaliation against the missile barrage on Tel Aviv a week and a half ago. Following that retaliation, we're expecting an Iranian retaliation, and the Iranian retaliation is what markets are really fearful of, because if Israel strikes oil refineries in Iran, then Iran has vowed to retaliate against other Arab states' oil refineries, and these Arab states could be friendly to Israel and or the U.S., and that could send oil up to $200 a barrel, according to some experts on the news. I'm planning to do interviews about that this week.
I was saying, who are these experts that say oil is kind of? Because I have to say something. It seems to me the only thing that matters when it comes to war is gold. Like, nothing else is really responding off of these concerns. Oil has a spike, then comes back down. Markets get nervous for a little bit, maybe a bit of a flight to safety trade and yield, and then back to normal. Gold holds on though on these headlines.
Gold's geopolitical risk premium, I've noticed ever since the Ukraine war, has been ephemeral. All right. So what I mean by that is, let's take a look at this. Is oil, and what did oil do on 9/11? Okay, you know what? Let me do a long-term oil chart.
This is how David does all of his research. We're actually doing a live version of how he does research.
Google.
Yeah.
Glorified Google.
Right, exactly.
All right, this is 1998. All right, where are we? September 11th, 2001. Okay. Oil went up, and I don't know how much of the subsequent increase over this decade was due to the war in Iraq and subsequently Afghanistan.
Yeah, because we were coming out of a recession then, right? All that stuff.
I think there's a lot of factors involved. It's not just the war in the Middle East, but you can look at this and say, okay, well, the geopolitical risk premium never left. That's one way to look at it. I don't think that's the only reason. Let's take a look at gold, though. A recent conflict, 2022 was a good one. So February 24th was when Putin's forces entered Ukraine. Where is February 2022? Right here. Okay. Gold was already, I remember covering this. I was still at Kitco. Gold was already going up because real interest rates have been declining ever since the beginning of the year 2022. And then when Putin decided to invade, it shot up from, where were we? Yeah, about 1919 to over 2,000 overnight. It didn't stay. And I remember interviewing people at the time and just reading the news. Analysts were factoring in a $200 gold premium, and it just never stayed. I think gold's premium, if you just look at how it's responded to previous geopolitical tensions, especially the geopolitical risk premium. I'm not talking about like economic risk premium. That's different, because then we're starting to factor in lower real rates. We're starting to factor in perhaps lower inflation. Remember, gold likes disinflation as well. Gold likes deflation as well as really high inflation. The in-betweens is when it starts doing badly. Anyway, gold didn't do well in the subsequent months. So I would argue that the geopolitical risk premium baked into gold doesn't last very long, unless we're expecting the war to affect other parts of the economy that are also good for gold, like inflation, perhaps.
And by the way, that point is brought up by somebody watching on YouTube, Haviland here. Iran and Israel news are not shaking markets at all. Have you guys seen gold despite these attacks? Gold actually went down after the attacks. That's consistent with what you're saying, that it's like, yeah, I mean, it's not as clean a relationship.
Yeah, I think, look, the issue of what really drives gold is something that I've been constantly asking people for the last 5 years, and I'm going to be very, very direct. I have not gotten a single.
No one knows. Exactly right.
I asked person A, they give me, three sets of answers, and then person B gives me. I mean, you know this space better than I do. So I just think that there are a few factors that have consistently driven gold. The dollar versus gold, but as I'm about to show you in just a minute, the dollar and gold's relationship this year has also been fickle. In the early part of the year, they both went up at the same time. Now they're diverging again. Real interest rates in gold. Inflation is something that is not actually correlated with gold at all. Yep. And I know the gold bullion marketers would say, well, no, that's not true, that, gold's an inflation hedge, because if you look at how it's grown over time, you can buy a suit with like 1 ounce of gold in 1920. You can still buy. That's not an inflation hedge, guys. That's just assets going up over time. Inflation.
That's just Temu. You can just buy a suit for like $1 on Temu, right?
Right. Okay.
It's not about the gold. It's about Temu.
Yeah, Temu has been deflationary for our lives. There we go. And so is Amazon. No, but the argument that gold has kept its purchasing power over the last century is true, but that's not, to me, an inflation hedge. An inflation hedge is something that is negatively correlated with the CPI growth over any time period that you want to look at, and it just doesn't really do that consistently. Okay, because whenever gold goes up, this year, let's just take a look at this year. Gold has been going up all year. Where has inflation been going? Down. Last year, gold was going up. Where was inflation? Up. The previous year before that, where was gold going? Down. Where was inflation? 2022, inflation spiked to its all-time, well, not all-time high, but its then all-time high of 9.1%. So in 3 years in a row, we had inverse relationship, positive relationship, and then inverse relationship again. It just doesn't work all the time. It does have a pretty close correlation with negatively correlated with real interest rates. That's what I'm trying to say. It's pretty close. And then the dollar, let me just show you what's going on with the dollar right now. The dollar, I'm looking at the DXY. It's a basket of, it's a dollar versus a basket of other currencies. The DXY moved a lot because of other central bank policies this year. But if you just take a look at this, now what I meant to do, if you just take a look at the direction in the beginning of the year, they both moved up together and then they started diverging. Yep. So, it doesn't always follow perfectly. Long term, however, you can see periods in which, for the most part, they've moved inversely together. And the notion that gold is the anti-dollar asset, and so they always have to move opposite to each other. Again, if you just look at the charts, even just in a short-term basis, it's not always the case.
Yeah. Are most of your guests dollar bullish or dollar bearish now?
Oh, no, it's been a mix. People give all sorts of reasons for why dollar is up. I can give you a narrative for why the dollar could be bullish. I can give you a narrative for why the dollar could be bearish. It just depends on what people, align themselves with.
Yeah. Is there any kind of overarching theme, though, across guests recently, like the last several months? Are they uniformly bullish, bearish, certain sectors, asset classes? What's the common thread?
The bears are turning bullish, and the bulls that have been right all year are now getting worried.
Really?
Okay. Consistent theme in the last couple of months. I've been interviewing the people that have been bullish ever since last year. I brought them back on the show. I congratulated them for the right calls, and they're expecting a 10-15%. Some of them are expecting a 10-15% short-term pullback. Long-term, they're still bullish. The market bears that have been calling for a bear market this year hasn't happened to a significant long-term degree. They've started turning more, I wouldn't say bullish, but they've been less bearish. They're now projecting. They're not saying things like, well, I think the momentum in the S&P could continue until we get to new all-time highs by the end of the year. After the election, we'll see. I think this momentum will sustain until the end of the year after the election. And then depending on what the next president does with the Middle East, with Ukraine, we could see more tensions, more volatility. That kind of narrative wasn't there last year when people were like, no, we're definitely getting a recession. Things are going down. think people are backing up on this call. The bears are still pushing back their recession forecast on my show, by the way. So they haven't really given up on that. And these aren't just gold bugs. These are esteemed economists who have a bearish slant. So that, because the underlying fundamentals of their thesis haven't changed, which is a deteriorating labor market, which is lower consumer spending. If you're monitors like Steve Hanke, who's a regular, a decrease in the money supply usually portends economic slowdowns. And I know what you're going to ask me, the jobs market, killer jobs market, jobs report last Friday, 240,000 jobs added. The consensus expectation was 140,000. Larry Kudlow interviewed Donald Trump on Fox right after the jobs report came out on Friday. It was a pretty interesting interview. They talked about a lot of things. But let's just take a look at what happened with the jobs report. I'm going to pull out the jobs report here. So jobs report, employment situation. No, this is not the one. I want the breakdown. Okay, I'm going to pull up that table in just a minute. I'm having trouble finding the breakdown.
But by the way, I love all these comments, by the way, on X, like asking about gold, asking about the Buffett indicator, asking about your hair. I mean, there's a nice mix of people.
We'll have to make the list of things to get through. Okay, but I remember the numbers off the top of my head. Okay, so we have 31,000 new government employees added. So that is more than the 27 or so thousand. Hold on. So that is more than last month for sure. And people were commenting that a lot of it was due to two things. A lot of this growth was due to, yes, we have increases in healthcare, we have increases in hospitality. However, we also have increases in government workers. A lot of the workers were foreign workers, and Kudlow made this point to Trump. A lot of it came from immigration. And then Trump spotted us as an anti-illegal immigration, campaign rally again. But he made the point that immigration caused a lot of the increase in employment. Domestic workers actually, their employment actually fell overall, and part-time work increased. So looking under the surface, a lot of it didn't really seem to improve as much as one may think. Talking about the labor market situation overall, and people are expecting revisions again because fool me once, shame on me. Fool me twice, no. Fool me once, shame on you.
You just pulled a George Bush.
Yeah, I just
pulled like fool me once, shame on you. Fool me twice, ain't gonna shame me again. Like
the left hand doesn't know what the right hand's doing.
You're from Canada, I get it, man. It's okay.
The BLS revised down 818,000 jobs. A couple months ago. Okay, again, revisions are a normal part of the process, but a revision that big hasn't happened since I think 20 years ago. Anyway, people are expecting revisions, but the revisions calendar is going to happen right after the election. That could just be a coincidence. It's been scheduled, but people were like, "Well, of course."
That is in no way a coincidence. That is planned way in advance, my friend. No, I think it's interesting though. Okay, so. But even with that tilt, to your point about the bulls are getting more cautious, the bears are turning bullish. Nobody's doing anything about their portfolios yet, right? I mean, I always go back to like people say things, but whether they actually act on it's a whole different animal.
Yeah. Okay. How do I say this politely? The most extreme bears. Some of the questions on my show is, are you shorting? It's like, no, I don't like shorting. I'm just staying the sidelines. Sometimes it's like I'm just in cash. I'm waiting for it to happen, like to hedge. And sometimes it's just a matter of, there's other ways to diversify your portfolio than shorting. So it's a good trading philosophical question as to what you do when you're bearish. And to some people's credit, shorting is not the optimal solution because it's expensive, right? It's probably better risk reward if you hedge with assets that are non-correlated with stocks. What do I mean by that? Perhaps the tips, perhaps gold, perhaps real estate, perhaps treasury yields, or treasuries overall. That seems to be a common play amongst bears, buying treasuries, because the yields typically is positively correlated with stock markets, which is to say, if stock markets go up, yields go up, bonds go down. If stock markets go down, bonds go up. I think that is a play there. Shorting the market is, usually you need to be on margin. It's expensive and it's risky. So they do it by being more cautious. Defensives have been going up. I think if you don't even just, notwithstanding the guests on my show or yours or other media, if you just take a look at what the market's doing, let me flip over to my screen one more time. This is institutional buying of defensive sectors. This is what people are doing with a more bearish thesis, I guess. Take a look at the S&P 500. I don't think you and I have talked about this yet because this started happening after the last time you're on our show. By the way, shameless plug, go watch Michael Gaia's last interview with me. He called the Japan reverse yen carry trade.
And I said the market would probably rally hard after that. It's like everyone was high-fiving me that day on August 5th for the same reverse carry trade happened.
I'm still waiting for the credit event to unfold, though.
I am too, by the way. I've been, it's like the only credit event has been on people that are, the trolls have been the inverse credit event. There's more of them as the credit event doesn't happen.
Utilities, so XLU.
But hold on, let's talk about this, because I think on utilities, on gold, okay, no credit event, no recession, no bear market.
Right? It's been performing the S&P dramatically in the last 3 months.
But here's the thing, like, wouldn't you think, as somebody who's been in the business for a while, wouldn't you think that if at the start of the year I were to tell you gold would be up as much as it is, utilities would be outperforming as much as they are, would you think the S&P would be doing what it is? I mean, I personally wouldn't. If we knew with perfect foresight that gold and utilities would be among the two best performing parts of the marketplace, I would have thought the S&P would have been down, because those are very defensive plays.
Yeah. I mean,
hasn't mattered. I get it.
3%. People are used to a 20%. Yeah, I see what you're saying. People are used to a 20% year-over-year S&P. It's been happening for like 2 years in a row now, and now we're only getting 3% on a 3-month change basis. So people aren't going to be happy about that. Yeah, if you had told me that defensives should start outperforming the S&P, yeah, I would agree with you. I would agree with you there. But this is just to illustrate what people are doing about a more defensive outlook. They're literally switching to defensive. So I don't think the market is doing nothing about it. I think they have already done something about it, and now it's just a matter of, okay, where does it go from here?
So hold on, let's make an ultra bull case. Let's try something different, right? So let's say the defensive posturing comes out of the market. Any guests of yours that are saying, you know what, we're going to have just like another huge run, that it's going to be small caps, that we're at the early stages of a melt up, not in the late stages of one?
Yeah, several of the bullish guests on my show who have been bullish, who are now a little bit more cautious on the S&P, have been very bullish on small caps and the Russell. The reason is small caps have historically outperformed during Fed easing cycles. That's one of the rationale. Also, as remember a couple months ago, people were concerned about the debt wall, the debt wall, the wall of maturity, the wall of worry, climbing the wall of worry. The worry has more or less dissipated now that interest rates are on the verge of coming down and things haven't exploded across the board yet. I mean, we have seen a rise in bankruptcies in corporate America, but it hasn't come to it's not like pandemic 2020 levels yet. And so I think that wall of worry is starting to die down a little bit. And so those two things combined, the question of whether or not small businesses can survive interest rates and the question of whether or not the Fed will cut rates, those questions have been answered. And so that portends a bullish thesis for small caps. Tech companies as well have historically done well during declining interest rate environment.
But those would still be large cap tech, right? I mean, we're not talking small cap tech.
Tech would be large caps, and then small caps would be everything besides the large cap tech stocks.
Right.
I mean, there are medium tech stocks, but medium sized tech stocks, but that's not what I'm talking about. You're right. So yeah, declining interest rates and the bankruptcy issue being resolved. Now, I think that if you just take a look at how the Russell's been performing, some of that thesis is already starting to validate. So I think, if you have, but it also makes sense because if you're bullish in the stock market, you're going to be in high beta, high cyclical sectors, and small caps are high beta. So if you're bullish overall, that just makes sense.
Let's talk about path of rates, because there is a possibility that the Fed made a mistake by cutting rates. It's like I start to hear more and more people starting to say, well, we're going to have another reacceleration now of inflation. Are other guests kind of emphasizing the same concerns?
Well, okay. So, it's very difficult to answer that question because I talk to everybody.
Yeah, I know, because you put out more content than Trump gets fact check. Goes back to that.
The people who agree with the Fed say no, and the people who disagree with the Fed, would agree with you. Okay, so I've been, I interviewed Alfonso Picatello. I don't know if you had Alfonso on your show, but he's a great strategist, great guy. And a week before the Fed cut rates, he told me on the show, I'm expecting 50 basis point cut. And he was the first guy on my show who said that. And I said, wait a minute, are you like, is that a joke? Are you like, can you just reiterate that? Can you expand on that? He's like, I don't know. I think they should have cut in July. They missed that for whatever reason. They were waiting. And now the data has indicated that they need to cut rates. And so they need to play catch up. Okay, so I put that in the headline. Turns out he was right. I mean, to be fair, he didn't say it's going to happen. He said there's a high chance it was going to happen. He said that before the CME Fed Watch tool gave an overwhelming probability of a 50 basis point cut. Other people have said that the Fed doesn't need to cut at all. And the reason for that is because inflation has already come down on its own. Why do you need to stimulate more and risk reigniting inflation? The inflation rate has come down to 2.5% without any Fed cuts. So in theory, why would you need to do that? And if you're in the soft landing or no landing camp, which a lot of my guests are, by the way, then the argument for a Fed cut just seems moot at this point, because why would you need to cut? Well, and the answer to that is that the labor market has been showing signs of deterioration. Most notably, the Fed looked at the unemployment rate, which has been going up. And so the argument that they don't need to cut rates isn't taking into account the fact that policy is lagging. And so if you don't cut rates now, you can risk inducing a forced recession down the line and making the labor market even worse. And so they're kind of just looking 6 months, 8 months out ahead, I think. So in my opinion, if you're asking me, I don't think they made a mistake, given that a lot of policy is a self-fulfilling prophecy. If you don't do anything now because you're expecting things to be worse down the line and things are okay now, you may actually just make it worse. Just funny story off sidetracking here. I attended the CFA conference in 2017 when Janet Yellen was the guest speaker, and the audience asked her what causes a recession, and she said two things causes a recession: financial instabilities and the Fed. And there was laughter, but I don't think she was joking.
Yeah. At least she's somewhat honest.
Yeah. What is the Fed going to do now? I think after this labor market, this jobs report on Friday, I don't think they'll cut by 50 basis points in their next meeting, which is in November. And in fact, I'm looking at the CME Fed Watch tool right now. There's an 89% chance. I'll just show my screen. Might as well. There is an 89% chance that we are getting only a 25 basis point cut. 475 is the current target. 450 is the next target. If you look a year out, though, significant probability of. Okay, so you see, this is interesting because a couple of days ago, that target was 250. And now it's only 325, which is only a 150 basis point decline from current levels. It was a 200 basis point decline last week. So the recent jobs report really played a role in how markets perceive the trend of forecast. By the way, this is more in line with what the Fed dots plots was projecting, which, by the way, if anything, my guests can agree on, bulls and bears, that the Fed dot plots are not a good indicator of what's actually going to happen. I think that is just universal consensus by this point. But anyway, the median expectation was 3.4%, I think is what Powell said at the last meeting. So this is more in line with the median expectation. The markets were a little bit more aggressive in pricing and cuts up until basically today, we're a couple of days ago. And a lot of my guests have said that the the path of rate cuts is a little bit too aggressively priced in by the markets, and now it's looking a little bit less aggressive. So that's yeah. My take is that this curve looks a bit more realistic, I would say, than 2 weeks ago.
I wonder how the market's direction would impact that. Meaning, if the S&P were to go up another 15% into end of year, that would be inflationary from a wealth effect perspective, right? So it's like you might be at a point now where the higher equities go, the more rates will have to stay elevated.
Let's talk about that. That is an interesting philosophical question. I say philosophical because you have to assume that the trickle-down economic theory,
right?
Reagan trickled down. The wealth effect, the wealthy get wealthier because they are the ones that own the stock markets and financial assets. And research has shown us that the wealth effect does affect spending, more so on the downside than the upside. If you own a house, for example, and there is a property bubble collapse, on paper you are poor, even though your cash flow doesn't change. Perhaps you still have a high-paying job. You're a doctor or a lawyer. Your cash flow doesn't depend on the housing market in those professions. However, you spend less because you feel poor. Vice versa, also, you spend more if you feel wealthier. If you're a doctor and a lawyer, your cash flow doesn't change, but you're spending more of your disposable income because all of a sudden you're a millionaire, whereas before you weren't in the 2 comma club yet. Yeah. So the wealth effect does work. Now, you're assuming that if the stock markets go up, people spend more money, and that trickles down to the working class. That is a subject of a lot of academic debate. The liberals say yes, and the conservatives say no. The liberals say no, and the conservatives say yes. So I don't have a clear answer to that. It really depends on what political agenda you have.
Well, although actually on that point, it'd be interesting if the sense is that the Harris administration would cause more taxes on stocks, then the more the stock market goes up, the more the trickle down might matter because of the effect on spreading that taxable unrealized gains right across the population.
Yeah, I don't think the unrealized gains is actually going to get passed by Congress.
No, it's not at all. Yeah, no.
People talk about it is like one of her more out there ideas, but I don't think that's going to happen. But but I talked to somebody who was in the know on this policy. By the way, it's only okay. So let's look at the actual proposal. The unrealized taxes apply in theory so far to only those people, individuals, not corporations, not LLCs, not funds, but individuals with a net worth combined of $100 million or more. That equates to roughly 10,000 people. Now, the counter argument is, well, yeah, those 10,000 people control most of the stock market. And so if they start dumping, we're going to lose hundreds of thousands of jobs. So because there's going to be forced liquidation and no buyers on the other side because nobody wants to take on the responsibility of paying unrealized capital gains taxes. So that's just bad across the board if you look at it from that perspective. However, if you take the liberal perspective, okay, it's only 10,000 people. You and I aren't going to be affected. I'm assuming you're not worth $100 million, correct me if I'm wrong, but assuming you're not, you and I aren't going to be affected. And so the argument that everybody's investment portfolio will take a hit is not an immediate effect. However, I think the stock markets will puke either way, even though I don't have to pay unrealized capital gains taxes. Now, the capital gains taxes, she plans to raise that either way. That's just across the board to 28%. That I think the market could absorb over time. It wouldn't be as bad as unrealized capital gains taxes, which would completely disincentivize any form of productive investing whatsoever. But yeah, she does plan to raise taxes across capital gains overall, and she does plan to raise taxes on corporate taxes overall as well. So I think either way, the stock markets were correct on a Harris win. But long term, I don't think that's going to be entirely. The stock markets don't react entirely due to taxes. Because taxes have gone up and down over the last couple of administrations, depending on who's president. And the stock markets have only grinded higher over the long term. So I don't think it's independent of tax policy unless we get unrealized capital gains taxes, which would be unprecedented.
You ever feel like you're more knowledgeable than some of your guests?
No, I don't.
No, come on, man, because you're killing it here. You're hitting on so many good points, and I feel like you're putting out so many more nuggets than a lot of people that are on these kinds of shows to begin with.
I appreciate it. I mean, I just feel, yeah. I mean, I learned from people like you. I talked to Michael Guyette and others.
You don't learn from nobody learns from me, man. I'm like I'm just a guy apparently that's a joker that's putting out all this content and research, but it doesn't matter because markets keep going up, and who cares about trying to think different?
I did learn to look into the yen carry trade because of you, really. Because of you, I wouldn't call myself an expert. And I just want to end on this note before we move on to the next point. Let's take a look at my screen. I'm not saying this was the cause of market movement, but if you overlay this with USD yen, okay, S&P year to date up until the August break, it was very much correlated. Now, I don't have probably an explanation on this as you. I'll let you comment on this, but I just find that this is bizarre because this is not always the case. The dollar yen does not drive the S&P 500, but they're very much correlated this year.
Yeah, which goes back to that yen carry trade of borrowed money against, from getting cheap leverage from Japan, deploying it elsewhere. It mattered for 2 days, and everyone forgot about it. Right? I don't think it's over personally. I've said that many times before, but even I have to recognize that. You know what? Yeah, I mean, you can't ignore what the S&P is doing, right? I mean, small caps still hold the key. I feel like I'm on repeat saying the same thing over and over again because nothing's really changed. To your point, right, about what economists are saying, it's like nothing's really changed. We're still in these lag windows. Things are still disconnected in terms of large versus small, in terms of credit spreads against zombie companies. But nothing matters, right? Because, hey, passive wins and everything else be damned.
It's interesting because nobody was talking about the yen carry trade except you on my show until first week of August. And, people have been giving me all sorts of reasons to why the S&P was going up all year, and nobody has signed this as a reason.
Exactly. Yeah.
So, I looking in the rearview mirror, it makes some sense.
Nature of the beast.
People, this was an indicator that was missed all year round, is what I'm saying.
Yeah.
Who knows? There's maybe something else that we're missing right now. I don't know what that is until someone tells me about it once it moves.
Yeah, I think that's exactly right. Let me ask you, what's the end game for you? So you're building up the YouTube channel, right? You've got the Substack, right, which you're building up, I think, fairly nicely. But like, what's your end game? Are you basically trying to be the next sort of financial empire? What's your goal?
Well, one step at a time. So I think to your point about me just doing more of my own takes, that will come. I just need to grow my team. Currently, I have a producer and an editor, so I need to just grow my team, have more production output. So it'll not just be interviews, but it'll also just be me doing the news. Not so much my own analysis, but just reading what's been happening that day or the biggest news items of that week. I'll also be doing more explainer videos, explaining concepts, things that are more evergreen. Longer term, I want to grow this network into not just finance, but also tech news as well. I may bring in some other reporters to join my show. It will be rebranded once that happens. And I think I've told you about this last year. This was always my vision. And then the next step after that is to diversify into financial products. I don't know what those are going to be yet. I'm not launching a fund. That's not what I'm doing. But perhaps like a database to help investors navigate trades, perhaps information that could link my news and my videos to a trading platform. I see myself maybe partnering with a trading platform. So I want to just leverage information in the media format to information on a fintech platform. Long term, I think I want to grow a fintech company, not just a media company. But this is a starting point.
Dude's a beast. Everyone that's watching, appreciate those that watch this live. Make sure you like and subscribe to David Lin's channel, as well as hopefully mine, Lead Lag Report. Appreciate those that watch this. Any final parting words of wisdom, David?
Yeah, watch the Lead Lag Report.
And watch the David Lin Report. They have one thing in common, report.
Words of wisdom for who? Investors? I don't know. Yeah, dude, don't ask me for words of wisdom. I failed at trading. I told you this. Okay? I'm the last person you should take trading advice from. Watch my show and listen to the people who actually know how to trade.
There you go. David, I think that sums it up right there. David is greater than CNBC from a YouTube comment there. Appreciate those that watch. I'll see you next time. Thanks, David. Appreciate it.
Thanks for having me. Thank you, Michael.
Cheers, everybody.